All right, hey, what's going on? This is Dan Keller, your mortgage advisor at New American Funding. I want to welcome you to another episode of Making Sense of the Market. Today is Friday, May 19th. Happy Friday. So, what a crazy week. I told you on Wednesday, if you follow me on Facebook, I did a Facebook Live report basically talking about what happened in the market this week. So, the stock market, now, right here on the screen, this is the bond market. Remember, I most of the time talk about mortgage bonds and mortgage-backed securities. That's what this is. The stock market on Wednesday plummeted over 300 points in one day. That's not good. So typically what happens when stocks drop like that, mortgage interest rates improve. And they did a little on Wednesday, not as much as people expected, and that's what you're going to see right here. We had a little bit of like a 50, 60 basis point improvement. But what you're going to see, I'm going to get to this in a second. You're going to see where we're at. What caused that? What caused that was, and everyone thinks what caused that market movement was talks of impeaching Trump. That's not it. What has caused that is the stock market had certain expectations in regards to tax reform and healthcare reform. And on Tuesday, the Trump administration came out and they put a hold on the tax reform. A lot was pending on that. So my advice to you, kind of like down in the trenches level advice, is where we're at right now, as long as there's talks of impeachment, as long as we do not have health care reform or tax reform bills being passed, we're going to see some volatility in the market. The great thing about that volatility is it's somewhat predictable. Here's the predictable aspect of it. See this dotted line right here? That's the 103 mark that I talked about on Wednesday. Every time, we've hit this mark 5 times since the election. Every time we've hit this mark, guess what's happened? Mortgage bonds have actually worsened, meaning rates leveled off or they got worse. That's exactly what happened. I said it on Wednesday. Look what happened. So we're down below that 103 mark. Today obviously is Friday the 19th. So it's predictable in nature if you're working with a pro. That's me. I'll keep you informed. But what I really want to move on to today, which I just talked about, news you can share about the Dow and the health reform. I want to talk to you about where rates are at. Government rates are still in the upper 3s. That's 30-year fixed rates with FHA, VA, and USDA home loans. That's great news. Still a great time to purchase a home and get a very competitive 30-year fixed. Fannie Mae, Freddie Mac loans, conventional loans, depending on the type of property you're buying, how much money you're putting down in your credit score, mortgage rates are still in the low 4s. Great news. If you haven't, I'm going to take this minute right now. If you have an interest rate over 4.25%, or if you're currently paying private mortgage insurance, reach out to me. Let's talk about potentially refinancing your home. This is as good of time as ever, okay? This is what I want to talk about this week. 6 steps to financial freedom. I'm going to continue to bring you some information on this. Paying off credit card debt. That's a big part to the 6 steps to financial freedom. There's a lot of controversy out there when you're dealing with debt, which debt to pay off first. Remember, last week I talked about a couple of these stats. 80% of Americans are in debt. 55% of Americans actually lose sleep over money issues. So, which debt do I pay off first? Do I pay off the lowest account first and get that psychological impact of achievement, or do I pay off the highest interest-bearing account? The correct answer from a financial guy like me is you want to pay off the highest interest account first. Sometimes it's the largest account. The downside to doing that is you don't get to see the progress that you'd like to see and the satisfaction of crushing a payoff of such account, like by paying off the lowest balance account first. So total cost of your money, it's smarter, it's more intelligent to pay off the highest interest-bearing account first. But if you're somebody that is results-driven, pay off the lowest balance account first. Take the savings from that account, pay off the next one. That's the Dave Ramsey snowball philosophy or approach that he uses. I don't care which approach you use. If you're in debt, start paying it off because debt costs you money. If you have any questions, let me know. I'm out of here. Hope you have a great weekend. Please share this information with somebody that you know. And I'd love for you, if you know of somebody that can use my services, I would love an introduction. Okay, I'll talk to you guys next Friday. Take care.